Welcome everyone to another episode of the Everyday Trader. This is Greg. I got a haircut, Eric.
I get a haircut too. Why?
You
Why'd
got-
you get a haircut?
I'm going to Vegas. You got to look sharp when you go to Vegas,
Gotta
right?
look sharp in Vegas. You and me at the craps table. Who are those handsome devils with
Hey, is Barry
the
coming?
silver hair, the beard?
Barry's coming, right?
Barry's a little shiny on top though.
We'll get Barry on the craps table with us too.
Get some
So
other people too on the craps table. Sam Jackson's gonna be there. That'll be fun.
it is
Samuel
gonna be
Jackson. He
That
might
is
be
gonna
my
be good to,
taxi
good
and
to
pick
see
me up at the
Sam. Good
airport.
to see old
Yeah.
Scotty G,
Scotty H. I
Scotty
don't.
H. Is
Oh,
Scott Hartman coming?
yeah, we can't start. I think Hartman's coming. I don't. There's a whole bunch of people on it.
Sorry, we're sharing your names, everybody. I hope you're okay with it.
Oh yeah. We shouldn't we shouldn't start picking names because we're gonna definitely forget something, but
It's just YouTube. No, it's nobody watches this.
just YouTube, nobody. Greg, we have 1,000+ subscribers now. So we get
do.
hundreds of people.
Thank you,
watch
by
this.
the way. Thank you.
And
for
why
those-
do they watch? Because they want to get timely insight and thoughts and hear your perspective on stuff. So let's not to move things along, but let's move things along because I gotta pack and get on a plane tomorrow morning.
You and I both, but yeah, the markets had a rough day today on the back of a CPI report that came in hotter than expected, at least hotter than expected for the general media. It was right in line with what you and I have been talking about for quite a while, is that inflation is not done. The market is not priced accordingly for interest rates remaining higher for longer, because that does look like the likelihood that is going to be the case. In fact, that's really one of the things I believe that put downward pressure on the equity markets today was higher yields based on the idea that, yeah, the Fed's not cutting rates anytime soon, even at all this year. And yeah, you can see it doesn't, when you look at the chart and put it into perspective, doesn't look too drastic of a move considering the move up we've had since the lows at the end of October last year. However, if you're a chartist and you combine some technical analysis tools, a couple of setups that are happening, the RSI pushing through 50 to the downside, the MACD has crossed over and is trending lower, and we got a 5 and 20 exponential moving average crossover about ready to happen. Hasn't quite happened. I think we have one more down day and it does happen.
Yep.
The market's maybe poised for a sell-off right now.
So those are charts don't tell you what's going to happen. Charts tell you what did happen. But if we do get a 5 and the 20, it will confirm that we've had a change in trend. Now, that does not necessarily mean that the trend will continue down or bearishly. It's just telling you that whatever this bullish trend is over. Now, you can look back in history and see earlier, like this time last year, that we had a lot of back and forths. And things going on here where we had trend changes and crossovers. So be very careful driving your bus using technical analysis. I always say that's like looking in the rearview mirror and driving forward, because without looking through your windshield, we're only looking backwards. There's other macro stuff that's going on. I have a personal opinion on why we're seeing the market pull back. And that is next week is tax day. And you and I were talking about taxes. And this is not an iota of an exaggeration, but we do have people who will sell assets in order to generate income to pay their tax bills. So it's not uncommon to see some sort of a pullback today, but taxes probably doesn't account for why the market went down today. The market went down today because why, Greg? Why?
I thought I was waiting for your dramatic pause.
I don't know. I'm not sure. That's why I'm asking you. I'm kidding.
It went up because it went down today because interest rates went up. They're oftentimes inverted, and the interest rates went up because of the hotter than expected CPI. The CPI data, driven mostly by an increase in oil prices. But I think what's happening is a lot of the expectation that first was expected to cut at the March meeting is when the expectation was. You remember, just rewind 3 months ago. at the turn of the year, the talk was there were going to be 7 rate
Oh,
cuts in the calendar year, that we were going to see interest rates back down to in the 3%, maybe even in the 2 handle by the time we get to the end of the year, because the Fed had conquered inflation, was the idea. I'm still of the belief that, quite honestly, I don't think the Fed can do much right now to control inflation. At least calming it down, I don't think they can. I think they can spur it higher if they wanted to. If they wanted to be accommodative, I think, and make easy money. And so I think the only thing that slows down inflation is to have a decrease in money supply, which at this rate just doesn't seem to be happening very fast. So, um, yeah, hot market, hot economy. Doesn't mean you have to be bearish either, by the way, folks. In fact, let me talk a little bit about that, because I think a mistaken notion is the idea that at 5% interest rates, at 6% interest rates, you can't make money in equities. I don't think that's the case. You can. The markets can still be bullish. The economy can still be growing at 5 and 6% interest rates. So don't say we have to have 0% interest rates to be able to have the market go bullish. That's not the case.
obviously not, because we've had an incredibly bullish market, a record-setting bullish market, really since the fourth quarter or the end of the third quarter last year. Things have torn higher. So we can have a bullish rate, and I mean, a bullish market continue with rates being higher. We looked at the Fed funds rates there at this 525 number to 550. I mean, I think historically, if you go back to 1955, we're not crazy high or crazy low, but if you look at the last 10 years or so, perspective's a lot different, and it seems everybody's calling for rate cuts, but I don't know who those people are because they're not looking at the data.
Yeah, I agree.
The
And
data
let
is, go
let me
ahead.
clarify. Sorry, I got to interrupt a little bit, Eric, because I know I sound like I just said the opposite side of two things. You asked me, why did stocks go down? And I said, because interest rates went up. And then I turned around and said, well, we could still have a bullish market with higher interest rates. So which one is it? Does the stocks go down with high interest rates, or does stocks go up with high interest rates? Well, they can do both. I think what you have to put into perspective is that when you look at the underlying factor of what's really driving the market, the lows that we put in October, and the rally up through just recently, clearly was about the presumed move that the Fed was going to cut rates. And now that they're not going to, that's going to come back out of the market. Now, it doesn't have to rush back out the same way it came back in, but what it means is the trend has to change and allow the rest of the economy to catch up. And so, to go back to what you said earlier, this trend change that we may be seeing may just be that the bullish move is over because the Fed's not going to cut rates anymore. And we'll probably see, at best, maybe a sideways market. We may see some correction through this summer. Now, I also agree with you. There's probably some other factors that are playing in as well. We talked about those the last time we met. The geopolitical issues that are out there, an election year that we're in there, the tax selling season that you said, that we're in right now. All of those play into some correction in a market that, quite honestly, has been really bullish. So, yeah, inflation's still around, and I think the Fed is probably going to sit on their hands for longer than what people are expecting. Okay, sorry, I'll stop interrupting. I
No,
promise.
it was perfect. I think that's a perspective that needs to be shared. Um, that I look at today's move as, there was certainly a correction in the market, and we saw stocks pulling back a little bit today, but I think it was a rather orderly move. We didn't end at the lows. We actually recovered a little bit, and we opened much lower due to the news, and the market trended lower, but then ended up coming back. We were down actually less than 1% 0.95 on the on the SPX index. Not a big move down for what you would expect is a change in sentiment. We did see a big shift that was clear. Let me pull up. I was showing this earlier. I think the Fed Watch tool, which has its limitations, but looking at where the next rate cut is, we're out to September now for the rate cut. So I'm definitely not going to eat my shoe, which I made an argument that I would eat a shoe in March. My wife asking me, "Did you feed the dogs?" No, I did not feed the dogs. I'm surprised the dogs are not going nuts. Sorry about that. So September, listen, I made a bold prediction last week in our options animal community. We do a weekly update with other peers. And so Charan Singh was on and Horace Taft, both of whom have been on previous episodes of the Everyday Trader. Great episodes, by the way. You should go back and check them out. But I told those, we were talking about the Fed and my prediction, and I put money on this. The next Fed action will be a rate hike. And I think people aren't coming around to it. I think we're seeing a major shift in narrative. And I don't know what Jerome Powell is thinking, but I have some ideas of what people around him are thinking. And this is from talking to those people one-on-one, that they are concerned about communicating effectively. The Fed has demonstrated how important it is to communicate to the market. And I think they're very sensitive about a dramatic shift in a narrative. And what I see is a subtle tweaking of a changing direction of this super tanker narrative, which has been to several rate cuts to now the language is, maybe less rate cuts, maybe no rate cuts, and Kashkari saying, I can imagine a world where we need to raise rates. And that's, I think, is probably everybody's opinion, but they're not all saying it. The reason I say that we might need to raise rates is if we look at what's happened to CPI, it's strong. And the Fed is well aware of the history of inflation, which in this country, we've had 3 rate cycles, inflation cycles since 1910. If you look at them on a 12-year period, they look like a camel with 2 humps. And I've said this here before, the Fed is very well aware of that. And the dynamics of making that happen, when you step back and you look at the Wall Street Journal and you see this hump here, and if you took this sort of thing and laid it over the previous, there's another hump that comes after them. It's happened 3 times. We've only had 3 cycles, and there are 3 times when that's happened. So the Fed is keeping a very close eye on what's happening here. And I don't think it has to be a bad thing for the market. We talk way too much about this. I think what we need to be thinking about is bigger things. And the economy is actually very strong. We saw a very hot labor market last week people are looking for the dark cloud and all the silver linings. So people were saying there are more part-time jobs in there. And okay, well, that still is a strong job market, and GDP is stronger than we thought. And there are definitely some dark clouds that are out there. I've got a good friend of mine who's in the trucking business, and he's really bemoaning how tough it is right now that shipping rates are so damn low. He's having a hard time making money, and he keeps asking me, well, how's the economy, Eric? I mean, we talk 3 times a week about this in his business. And he says, I don't agree with you. The economy's not good. Trucking is really hard. We aren't shipping things. Well, a big part of that is the destocking that's happened. Is inventories were built up, and now companies are working off their inventory so they don't have to ship. And looking at some of the data that's out there, Goldman Sachs publishes a report looking at some of these freight shipping, both containers, air, and over rail, and trucking. And their sentiment is that we're at the bottom of a trough, and things are going to start to get better. And I think from a trucking standpoint, that's probably what's going to happen. And because it's all tied to the economy. But if we took a look at, I wanted to peel back and look at CPI, if you're okay with that, like that chart that I normally do. Is that good now?
Yeah, because I think that will start to go into kind of some of the details. I think the worst case, while you're pulling that up, I think the worst case scenario, talking about your friend in the trucking company, and also referencing a lady that I do respect. I met her a handful of times. We spent time with her at Camp Kotok this last summer. Danielle DiMartino Booth has been very adamant that the economy is weak, that the housing market is collapsing all around us right now. I don't know that I agree with her. Maybe the housing market's collapsing in Texas, where she's from. But having said that, if they're right, if we are seeing the economy start to crumble up from underneath us, and at the same time we see inflation doing what it's doing, that's the worst word that any economist can come up with, and that is the concept called stagflation, where we have an economy that's slowing down and prices that are going up, which is bad for everybody.
Mm-hmm.
So I think as you look at some of these prices, and I know, Eric, you could do a great job of going into this, so I'm going to let you dig into the details. But when I look at this, the big change is in a lot of the big important ones, which is the blue bar, right? The blue bar are
Blue bar is the importance.
the blue bar is the important ones, and you see a lot of really big blue bars showing quite a bit of inflation. There's a few blue bars. There's the one blue bar there. What is that? New vehicles, right?
Which is down slightly. Yes,
Which is down just slightly. So
because
there's
we
a
all
lot of
buy new
inflation.
cars all the time. So
But
that
you look at the bigger blue bars like gasoline and transportation services and medical care services and rent of shelter, those are all still showing sizable inflation. And a lot of that is coming from higher oil prices. And oil prices have got some pretty good traction to the upside right now. So you want to dive into those a little bit more? I know you do a better job of this.
Yeah, you talked about you nailed it. So I like to look at these at two different levels. There's first of all, there's hundreds of things that are on here, everything from salad dressing to lingerie. I mean, there's 388 lines of things that get measured by the Federal Reserve, and then they assign a weighting to it to come up with an overall number. And so by weighting, rent of shelter is number one, and that includes buying houses too. It's a complicated formula. So it's basically what everybody's paying for their house. And it's the most important thing. Medical care services is number two, transportation services, education, communication. Now you're thinking, I don't pay tuition, but you pay this and you pay for a cell phone and you pay for your cable TV, and that's in there. So new vehicles, this is the first one that's down a little bit of the big important ones of the top five new vehicles. New vehicles going down isn't helping your average everyday person. Gasoline is the biggest change, and it's a very important one. Used cars and trucks are down as well. We're hearing stories about that, but I think this is more a function of there was absolutely crazy prices that were at one point. I could have sold my Tesla 3.5 years old for more than I paid for it. There were people offering that much because during COVID, all the issues, and now we're seeing, people like, oh, look at how low your car's gone down since. I'm like, it's just back to normal, what it would have been. So we're seeing these numbers come down in the used cars for sure. That's not very significant, but so the most important stuff is weighted at the top, and arguably it all goes to the right, especially the stuff that we spend money on. Every consumers are feeling it. These are prices, and we talk about, oh, the inflation rate came down. It's inflation rate is positive. That means prices are still going up. They're just not going up as fast. And it blew everybody out of the water. We were way above consensus in the report today. That was the knee-jerk reaction. This is sorted by weighting, and this is sorted by percent change. So women's apparel, so you have women in your house, their clothing is going up. Gasoline was actually number one. Jewelries and watches, which last month was low. I don't know. That must have been some sort of a quirk. But if we look at what's important in here, there's a lot of stuff that's going up, and what's going down is the less important stuff. I mean, down here, new vehicles we mentioned, used cars and trucks are the ones that stand out that are going down, and cereals and other cereal products not saving. You're getting your Rice Krispies at a little bit better price, maybe down at the Winn-Dixie. So inflation, this report surprised a lot of people, and that's what's caused the reaction. I'm overall enthused. We're coming into earnings season, Greg, and any thoughts on inflation before we talk about what's coming up over the next few weeks?
Well, I think the same story, and you guys have heard me pound the table for the last 6 months about this. I think the only reason we were seeing inflation coming down over the last year is because oil prices came down. Some of it artificially manipulated by draining the strategic petroleum reserve. Now, oil prices are going back up again, and a lot of the things that were sticky in inflation are still sticky. And with oil prices going back up, I see that double camel, the second side of it going. I wouldn't be surprised to see inflation start to really pick back up again, because there's still a lot of money in the system. We do all still have jobs. We're not in a recession. I don't think the Fed broke the inflation with their increased rates that they were doing before. And so I think gold is telling us a story right now.
Hmm.
The fact that gold is at all-time highs, that Bitcoin is at all-time highs right now, that is a story that inflation is not dead. And those traditional, well, Bitcoin's not a traditional one, but gold is, and maybe Bitcoin's the new digital version of gold, that are telling the story that the inflation is still present, and it's a bet against the value of the US dollar right now.
It's a 20-year chart of gold.
Yeah, I mean, it has absolutely taken off this year.
Cowbunga.
I wish I had more than I have.
Why you're not going to sell it?
Nine, that's
Make you
probably
feel
true.
better that it's worth more?
I'm gonna have, when I die, I'm gonna have my kids replace my teeth with gold. Take my gold that, okay, maybe not.
All right.
Sorry, that was a bit morbid.
Yeah, there's something that's there, and it's a thing to keep. We all-time high in gold. We're near all-time highs in the market. I'm not going to call it top. I think we'll see higher numbers. It's not unreasonable to see a little bit of a pullback here and there. I'm very bullish on the economy from here on out and the market. We're coming into earnings season, and I'll change my opinion when the data changes. But from what I've been reading from some of the institutional reports, things are gearing up for a lot of strength in two sectors, specifically the financial sector. Uh, and looking at the large banks, not so much the regional banks, but the JP Morgans and the Bank of Americas and Citibank, that sort of, did I miss one? There's four of them. Why am I'm skipping.
Wells Fargo,
Wells
JP
Fargo.
Morgan, Bank of America, Citi.
Okay, there you go. There's the four, and earnings are this week. I placed a fairly, I placed a trade on Citibank that actually would do very well if the stock is explosive. I think Citibank in particular is going to do very well this week. They got earnings on the 12th, so we'll be in Summit in Vegas, and we can talk about that. The other sector that I'm bullish on, and I spent the week trying to find some good trades, is on the entire energy sector, and by that I mean the oil and gas, um, the whole supply chain, everything from upstream to services. I think I'm not sure that I want to play a super major. I'm probably neutral on those, although there's some selective ones. I was looking at Oxy. I know that's one of your favorites, and I know you like Chevron. I was actually looking to try and trade Schlumberger, Schlumberger, Slob, SLB, Schlumberger. And unfortunately, the option liquidity is terrible. I couldn't get filled at a reasonable price. I was looking actually at a double diagonal spread, which would benefit from different changes in volatility. And I tried like heck yesterday to try and get filled, and I wasn't going to overpay for that thing. So I'm not exactly sure how to approach it. Yeah, that's my thoughts on what's coming up. I'm looking forward to the rest of earnings season because it's a lot of fun. And in particular, we'll probably have things to talk about. Certainly when we get to the tech companies and Apple, there'll be lots of fun stuff to be talking about there. But right now, I think all focus is going to be on the banks, and I think that'll really set the tone for the market. I'm expecting. I think we're going to have a bullish week in the end of the week here in Las Vegas.
We'll see. We'll see. We're headed there tomorrow. So, all right, my friend. Anything else we need to talk about before we wrap her up for the day?
Never leave the table when you're playing with the house's money. No, wait, that's backwards. Uh, always bet on black.
Always bet on black. There you go.
All right. Thanks. Yeah, no, I think it's good. I'm looking forward. Hopefully we catch people. If you're interested and you can't make it, you can watch the live streaming by calling Options Animal 801-331-7500.
7,500. Yep.
7,500. So 801-331-7500. If you're interested in anything that we talked about here, learning more about, give Options Animal a holler, and we'd love to see you if we can see you. If not, we'll see you online.
Okay. Thanks, guys.